Every year, financial news sources like the Wall Street Journal and others always like to reflect on what they call the dogs of the Dow, referred to as a contrarian investment strategy that simply picks the 10 highest yielding Dow stocks at the beginning of the year and uses that as a contrarian investment strategy. Well, for the first time since 2018, the dogs of the Dow actually outperformed the S&P 500 and the market and the Dow Jones itself in general. But this is all about lessons in valuation. Let's figure out and look at why. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Once again, it's my pleasure to present this video here. I thought I'd have a little fun with FastGraphs here because one of the advantages of FastGraphs is we have these preloaded portfolios. The S&P 500 is in there, the Dow Jones, the S&P Dividend Aristocrats, and of course the Dow Jones 30, which is what the subject of today's video is about. And I thought I'd take this opportunity because it's really fashionable this time of year to talk about the dogs of the Dow. And, it's a strategy where they pick the 10 highest yielding Dow stocks and buy them at the first of the year and then, see how they do at the end of the year. And many, many times over history, that strategy has actually been an outperformer. But, rather than just mindlessly look at this as a strategy, my goal here as Mr. Valuation is to talk about why that strategy has been successful. Now, it hasn't been very successful in the last 4 years, or at least since 2018. And that's primarily because, as I've talked about many times, we've been in this, market where we've had massively high valuations, especially on growthier type stocks. And I'm going to kind of review that for you here in this video and show why that happened. So the Dow was really, the dogs of the Dow was really at a disadvantage. But if you're looking for building an income portfolio, there's other aspects of the dogs of the Dow strategy that you might want to take into consideration. And this year's group is kind of interesting. So let's go and let's look at the Dow Jones Industrial Average itself. I've listed it here. These are the 30 Dow stocks in the preloaded portfolio that you get from FastGraphs. And what I've done is I've listed them in order of the highest yielding to the lowest. And you can see that the top 10, which would be the dogs of the Dow, would be Verizon, Walgreens, Intel, Dow, 3M, IBM, Cisco, Chevron, Amgen, and JPMorgan Chase, and then followed as a close number 11 by Goldman Sachs. Now, these are all the dividend yields. These would be the stocks that we're going to be looking at for the start of the year. I do want you to see, as far as earnings yields go, from a valuation perspective, these are also amongst the highest earnings yielding stocks of the Dow. But there are stocks that did not make this list that also, would have good earnings yields, but not many. Goldman Sachs primarily would have a higher earnings yield, for example, than JPMorgan. Okay, so the point is, valuation is really what this is all about. So the first thing I'm going to do here, I'm going to go into FastGraphs, and we're going to start and do this in alphabetical order. And I'm just going to breeze through the 30 Dow Jones stocks for you. As you can see, Apple had gone through this period of really, very high valuations, and it's been in a correcting process for the last year. And that's one reason why the dogs of the Dow might have outperformed, because stocks like Apple were underperforming in 2022 for the first time in a couple of years. But let's breeze through this quickly and just look at it from the perspective of valuation. Amgen, currently one of the stocks, has been a stock that has performed the way I believe stocks should perform, and that is its price followed its earnings, and it stayed within reasonable ranges of valuation. There are times when it got overvalued and undervalued, etc. But Amgen is one of the Dow stocks, and it's currently fairly valued. American Express does not have the dividend yield, but I would actually choose it if I was actually building a portfolio for total return over most of the Dow stocks this year. I'd be curious to see how that works. Boeing has been on a tear here in the last couple of months, but as you can see, this company, and it's no secret, has suffered all kinds of problems, including what we saw with the COVID. But it hasn't been making any money. It eliminated their dividend, but hopefully they're getting their mojo back. Caterpillar has been a very cyclical stock. It normally, or often would fit into the Dow, the dogs of the Dow, but right now the yield is a little low because the valuation is a little high. Remember, this is lessons in valuation. Salesforce is a non-dividend paying stock, so it obviously doesn't meet the criteria of being one of the dogs of the Dow, but it's come into reasonable valuation for the first time, perhaps over the last 14 or 15 years. It might be a time, if you're looking for total return, you'd want to take a close look at Salesforce, for example, but it isn't a dog of the Dow. Cisco is, and it's reasonably valued. And again, I want to keep hammering that home. Chevron is one of the current dogs of the Dow because it has over a 3% dividend yield, but it's been a great performer last year, and it's still considered to be undervalued, but there are issues of what's happening with oil and gas and what oil and gas is going to look like as we've had this kind of assault on the fossil fuel industries, as we all are aware of. Disney does not meet the criteria because it obviously eliminated its dividend and has had, really some horrible times, so it doesn't meet the criteria as the dogs of the Dow. Dow is yielding over 5% and qualifies as one of the dogs of the Dow. And it's actually very inexpensive now. So again, it's a nice lesson in valuation with a nice 5% yield. This might be a good time. Now, keep in mind, pundits are suggesting that value investing is coming into vogue now. Of course, as Mr. Valuation, I always believe value investing is in vogue. And it's one of the reasons that, the dogs of the Dow outperformed last year, because most of the ones that were in the Dow, the dogs of the Dow for 2022, were very low valued stocks. Goldman Sachs, again, is one that just barely meets the criteria. It was number 11 on the list. It had a 2.91% dividend yield. I like its valuation. I would probably include Goldman Sachs if I was picking stocks rather than just submitting to the dogs of the Dow. Home Depot doesn't have the dividend yield, moderately overpriced, but you can see this has been a great growth story, a good performing stock since, going back where I'm doing this particular, I'm running this as a 15-year, but that includes a couple of years of estimates here. So over the last decade or so, Home Depot's been a really good investment. Honeywell as well. I also want you to notice most of these stocks were, either moderately overvalued or close to being fairly valued at the beginning, and they've all had good runs. And Honeywell I would consider overvalued, and it does not have the yield that would, qualify it as a dogs to the Dow. IBM is on the list currently with a yield of over 4.68%. This has been a company in transition, but it's starting to get its mojo back. So it's going to be one of the stocks in there. Intel's another one. This is one I'm not so sure of. They've had a really horrible 2022. It really all depends on what the stock does going forward here as far as building its earnings and its cash flows. I wouldn't, knock this stock out. It does offer a 5% dividend yield. It's certainly a better buy today than it was, let's say, a year or two ago. So Intel's one that's in the list. Johnson & Johnson, the AAA rated, little overvalued in my opinion, but it's obviously one of the highest quality companies on the planet. JPMorgan, is on the list. It's the lowest yielding of the Dow stocks, but it is also very undervalued. I think, between it and Goldman Sachs, I would like either one of these stocks. Coca Cola has perennially, traded at a premium valuation. It's a little too high now, but it does offer a 2.8% dividend yield. McDonald's, I consider significantly overvalued. Again, note how it was fairly valued. This would have been the time to buy McDonald's, not today. 3M has come into the list. They've had some issues lately, but I consider it very undervalued with a 4.85% dividend yield. Merck is probably still reasonably valued. It's really started to get its mojo back in the last 4 or 5 years. Notice that earnings growth has been averaging double-digit rates, and of course the stock has performed very well. It was undervalued back in 2010 when this, of the time from a measuring. Microsoft is a classic case of a great company that was extremely highly valued, in my opinion. It's now starting to come into more reasonable ranges. I still think it's overvalued, but it's certainly better than it was. Nike, similar story. It's rallied again here. It's still overvalued. I have some issues with Nike. Procter Gamble, perennially overvalued or fully valued. It's one of these stocks that commands a premium valuation, but I think, it's a little too high today. It does offer a 2.4% yield, though. Travelers, as in the insurance industry, doesn't have the yield that would be, qualify it to be one. UnitedHealth has been a really great stock, a great performer, but it's also been very highly valued for the last 2 or 3 years. And of course, it doesn't have the yield. Visa, similarly, you can see that once valuation gets extended, stocks tend to hit a wall. Visa has certainly done that. Great company, great results. Its stock price has really followed its earnings at a premium valuation. It's certainly trading at its normal PE now, but it's not a cheap stock, that's for sure. Verizon, much maligned, is very inexpensive, isn't growing very fast, but the real value here is in the valuation and the extremely high dividend yield. And you can say the same thing about Walgreens Boots Alliance. There are some issues, the opioid crisis. There's even talk about things happening like Mark Cuban coming out with his new drug, online drug pharmacy that, the Wall Street Journal said it was going to hurt Walgreens and CVS. But you've got extremely undervalued stocks here with a very high dividend yield, and it does have good growth potential going forward. So that's the Dow Jones Industrial Average. Now, these are the actual dogs of the Dow. And, these are the 10 stocks that qualify. And so what we're going to do is we're going to look at these stocks and see what happens as of the end of the year. But I do want you to see that Verizon offers a 6.25% yield, Walgreens 5.4, Intel 5.3, Dow 5.29, 3M 4.85, IBM 4.68, Cisco, CVX, Amgen, and JPMorgan. The thing I like about this current stable of the dogs of the Dow stocks, as Mr. Valuation, I think they're all attractively valued. We've got a few, like Amgen and possibly JPMorgan, that are really good growth stories. Most of the other stocks are true valuation stocks. I do want you to notice the quality of this group is high. A lot of them are AA rated. They're almost all investment grade rated except for Dow, which just simply hasn't applied for a rating, but I think would probably qualify for an investment grade rating. So these are the dogs of the Dow stocks. They're kind of fun to follow. We're going to see how these stocks perform over the next coming year. And, to really briefly go through these, just to, reiterate, I'm looking at operating cash flow here because these are all about dividends. I want to stay on operating cash flow. Amgen is covering the dividend very well. The stock is trading at a fair valuation based on cash flow, 3.91. I think this stock has really good potential, but I like it more for its growth characteristics than I do its valuation, although valuation is nice. Cisco, similar. Operating cash flow is covering the dividend. The stock is reasonably valued here with some good growth potential going forward. CVX got real close to not covering the dividend with operating cash flow in 2020, but it's been covering it since. I think the stock is very inexpensive, but the question is there going to be, some troubling announcements and earnings reports coming up over the next couple of years? You want to take that in consideration. Dow itself, operating cash flow covering the dividend. I think that's very good. IBM's operating cash flow has been covering the dividend. Their cash flows have actually been better than their earnings, and they're expected to start growing again, both in earnings and cash flows. I like it here. Intel's operating cash flow has covered its dividend, and although earnings don't look so hot, cash flow looks a lot better. And as a dog of the Dow with a 5.3% dividend yield, I think it's all about cash flow covering the dividend. JPMorgan, as a financial, they don't really report operating cash flow. The same as these other companies do. 3M's operating cash flow is still well covering the dividend. The stock is extremely inexpensive with almost a 5% dividend yield. I consider it, A+ rated. I consider it a no-brainer at these levels. Verizon, I've already commented that the operating cash flow is covering the dividend extremely well. The dividend has stayed, continued to grow. Even though the price has been low, I think this would be a great time to be buying Verizon. And Walgreens Boots Alliance also has cash flows that's supporting the dividend growth. So the dogs of the Dow coming into 2023 look like they'd be very interesting. But I do want to make a point. I think as a value investor, the valuations are good here. But as a dividend income investor, I think I also like the dividend yields and the overall yield of the dogs of the Dow for 2023. So, this would be one strategy that's been around for a lot of years and you could utilize, especially if you were looking for good income. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs. Thanks for watching. Hope you enjoyed this little look at the Dow Jones and the dogs of the Dow strategy. It's one that comes out every year. I just thought it'd be a little fun to go through it and kind of breeze through the Dow stocks and look at them primarily from a historical point of view. I've had several comments here in the last couple articles that all I do is look at history. That's not true. There's obviously forecasts here, but I'm showing you companies that are attractively valued that, you can spend a little time researching, because I think the valuations make it worthy of those research efforts. I hope you enjoyed the video. Give me a like, ring the bell, subscribe to the channel if you don't. And, obviously another benefit of fast graphs is you have access to be able to look at things like the Dow Jones or the S&P 500 or whatever and see it organized in a very effective way. You can look at valuation of the whole index. You can look at it, from a standpoint of dividend yields and so on. So anyway, I hope you enjoyed this video. Next week, I'm going to be launching the first of the series of dividend yielding videos that I talked about, where we're going to try to create like I did the models for, the last couple of years, where I did the model how you could put a dividend portfolio together in a bad market meaning an expensive market, using it differently than most people do. We're going to be looking at building a dividend growth portfolio for maximum income in the next video coming up. So you might want to watch for that. And again, we're going to be talking about valuation and looking at them for the income potential more than the total return, but I do expect it to do both. Thanks for watching. Talk to you again real soon.